Hello everyone, my name is Simphia Gambhir and I am an ACCA affiliate. As we all know that the world is constantly battling with the unprecedented change and impact caused by the COVID-19. In the view of the same, we will discuss certain key IND AS and IFRS accounting considerations related to conditions that may result from the COVID-19 pandemic. Our agenda for today's video is to understand why IFRS was introduced in India and what is the impact of COVID-19 on various sectors of the economy. And finally, we would also see the financial reporting issues arising due to COVID-19. Let's first start with India's transition to IFRS. So why IFRS was introduced in India? The IFRS issued by the IASB board were converged into INDAS rather than adopting them directly. And following were the objectives of adopting INDAS. Number one is elimination of multiple reporting. This helped the business houses in India like Tata, Birla, and Ambani, which also have registered offices outside India, to eliminate multiple reporting. Number two is easier global comparability. This is because investors, bankers, and lenders find it easy to compare financial statements of Indian companies with foreign companies using same accounting procedures. Number three is easy cross-border listing. This is because IFRS converged IND allowed Indian companies to get listed in American and European capital markets. And finally, we have better quality of financial reporting. IND AS follows the concept of fair value, which helped the Indian companies to reflect the true worth of assets in the financial statements. Insights by sector. COVID-19 is affecting economic and financial markets, and virtually all the industries are facing challenges, due to which we have some potential losers and potential winners. Potential losers include tourism and leisure, aviation and maritime, automotives, construction and real estate, manufacturing, financial services, education, and oil and gas. We also have potential winners who are showing staggering growth, and these include medical supply and services, food processing and retail, personal and healthcare, ICT, e-commerce, and agriculture. Now let's start with our main topic of the video, accounting considerations related to the coronavirus 2019 disease. The first question we would have in our mind would be whether COVID-19 is an adjusting event or non-adjusting event. Well, this would depend on our reporting date. This is because the coronavirus outbreak occurred at a time close to the reporting date. So what if our reporting date is before 31st December 2019? In that case, it would be a non-adjusting event. This is because as on 31st December 2019, there was an unidentified virus that had been reported with just few number of cases. And all the conditions that arose after the reporting date only require disclosures in notes to the financial statements. And for entities with reporting date after 31st December 2019, it would be an adjusting event. This is because the virus detected as corona and more information about COVID-19 is available that market will factor. And the figures in the financial statements would be adjusted so on. Going concern. Before I start to talk about COVID-19 impact on going concern, let's first understand the requirements of IFRS for going concern. IFRS requires the management to assess company's ability to continue as going concern, which is at least but not limited to 12 months from the reporting date. So, coming back to the topic, what are the impacts of COVID-19 for going concern? The impacts of COVID-19 outbreak have caused significant deterioration, particularly to travel and tourism, hospitality, entertainment, sport, retail, and the oil industry. Here, the management need to reassess whether these events or conditions, either individually or collectively, cast significant doubt on the company's ability to continue as going concern. In many cases now, 2020 budgets and forecast prepared in 2019 may now of limited relevance given the rapidly changing economic and business circumstances. Next is impairment. So why do we conduct impairment? Impairment testing is done so that assets are carried at not more than their recoverable amount. So what are the factors resulting from COVID-19 pandemic which indicate that the carrying amount of CGU is impaired? Number one is decreased demand for entities' product and services. Number two is increased costs and business interruptions due to supply chain issues and cancellations or postponements of orders by customers. Impairment testing requires careful consideration of the cash flow projections, growth rates, and discount rates. The projected cash flows should be based on what would have been reasonably been known at the reporting date of the conditions that existed at that date. For example, value in use calculation should not reflect the effects of restructuring plans and government assistance that has not been committed at the reporting date. COVID-19 would also impact the enforceability of the existing contracts. IFRS 15 and IND AS 115 provides criteria that needs to be met to account for a contract with a customer, including the approval of the parties to the contract and a commitment to perform their respective obligations. However, the parties may not be able to approve a contract under an entity's normal and customary business practices. For example, they may not be able to receive personal signatures. Next is onerous contract provision. Because of the impacts of COVID-19, unavoidable cost of meeting the obligations under the contract may exceed the benefit expected to be received. Thus, in that case, it would be an onerous contract. As per IND AS 37 or IES 37, a provision will be recognized for onerous contract. For example, increased cost of fulfilling a customer contract due to the replacement of staff who are infected, subject to quarantine, or otherwise banned from travel. Now we have leases. Due to adverse scenarios, lessees are receiving rent holidays and temporary rent concessions. In order to accommodate rent holidays and temporary rent reductions due to novel coronavirus, IASB and ICAI have proposed to amend accounting standard for leases. In a bid to fast track this relief, they have sought comments from their members. Now, what is this amendment? The proposed amendment allows lessees not to assess whether particular COVID-19 related rent concessions are lease modifications and thus would not impact lease liability adversely. Now moving to our last topic and the most important one, impact on key financial instruments. IFRS 9 and IND AS 109 financial instruments requires expected credit losses to be measured. Now, what are these expected credit losses? Well, expected credit loss is the probability weightage estimate of credit losses over the expected life of a financial instrument. Expected credit losses measurements need to incorporate forward-looking information that is available without undue cost or effort at the reporting date. This may be particularly challenging to do for the economic impact of the COVID-19. But despite these challenges, entities are still required to make estimate and update expected credit loss measurements. Entity will also explain the significant impacts of COVID-19 on the risks arising from the financial instruments and how it is managing those risks. Thank you for your time and patience, and I really hope that you liked the video. For such more videos, subscribe to the channel CA Simplified.